Today we've got some great listener questions for you, from how much you can spend or may need to spend in retirement. When's that best time to take Social Security? Is it age 62? Is there reasons that you should look at taking it at age 62? How much of your portfolio should be in one stock? And then, do you have an old life insurance policy sitting around that you haven't reviewed in a while and you're wondering, hey, should I still keep this, or should I be looking at maybe utilizing this cash value? Listen in to today's episode as we're going to answer these questions plus more, and you might find yourself in a similar situation, so we hope that it can help out.
Welcome to the Your Life, Your Money podcast with Scott Searens, teaching you how to thrive in life, wealth, and retirement.
Welcome to another episode of the Your Life, Your Money podcast, where we discuss thoughts, strategies, and actions to help you thrive in life, wealth, and retirement. I'm your host, Scott Searens, and as I mentioned at the beginning, today we're going to be answering listener questions. It's a great time to learn together, to learn from others, and you might find yourself in a similar scenario and able to relate to some of these questions and then take some of the actions and use them in your own personal situation. Before we dive into the listener questions, if you're looking for additional resources to help you build wealth, reduce your long-term tax picture, check us out at lifemoneyshow.com. Again, that's lifemoneyshow.com, where we've got additional podcasts, blog posts, and videos, all to help you in your financial future. So before I dive into the listener questions, I wanted to just bring up this article, actually from NPR. The article says the IRS faces backlogs from last year as new tax filing season begins. That's right, we're in the 2021 tax filing season, so I thought this article was really appropriate as a lot of people right now are, some people may have already filed, some people are gathering their documents to file, as I thought it would be just a good time to go over some reminders, plus talk about what this backlog that they're talking about might mean to you. So first off, what's the backlog? The article talks about, and I'm going to link to it in the show notes so you can see it here, but a report from the National Taxpayer Advocate reports a backlog of some 35 million returns that they're still working on that have yet to be filed. So think about that. There's 35 million returns from 2020, right? Not 2021, 2020, that they are still working on. Another thing, if you're somebody who has questions and you're trying to call into the IRS and you feel like all you do is get the busy signal, well, here's the deal. You're not alone. It says taxpayers who called in had a 1 in 9 chance of getting their call answered. So here's why I wanted to bring this article up and just talk to everybody about it. First off, I think it's really important because of this backlog. If you feel that you're going to be getting a refund this year, you may want to really focus on getting your return in as soon as possible, right? If you're getting that refund and they're backlogged already, that means you're just getting in this big line, this huge queue of people that are also probably looking to get their, looking for the IRS to recognize their taxes, file, review, and get that refund out. So get it in early. The other thing is, be hesitant, right? Now we already know, hey, there's a huge backlog out there. So it's probably going to take them some time to get your refund out to you if you're owed a refund. It might take them some time before they even acknowledge getting your return. And the other part here is I just want to stress to everyone, keep really good records. So when you submit your taxes, any tracking numbers that you have, any confirmation numbers, keep really good records on all of that. If you don't file electronically and you mail your taxes in, send it certified mail. Send it with some sort of certification where you're going to get a tracking number. Keep that tracking number. Take your notes on it, right? Hey, this is for my 2021 return. Make sure you keep that, scan it in, put it in your filing system, wherever you save stuff, right? So that way, for some reason, if something happens, you can always prove to say, hey, I sent it on, before the filing date, right? So everybody's got to have everything turned in by April 18th this year, unless you've got extensions or you've extended for some reason, but April 18th is the date this year. So you've got that tracking number to say, hey, I turned it in before the date. Oh, and I can see that you received it on XYZ date, right? So you've got your records that you've done everything on time. Yes, there might be some frustrations out there because of the backlog and because of the waiting, but I thought it was just really appropriate. Again, I'll link to the article in the show notes so that way you can read for yourself the backlog that we're seeing on the IRS standpoint when it comes to taxes. Okay, with that, let's dive into some listener questions. Here we go. Our first question today is from Deborah. And Deborah says, I want to have a lot of fun and do a lot of traveling when I retire. But to do what I want to do, I'll need to have an income in retirement that's higher than my income while I'm working. Now, would that be considered irresponsible? Wow, good question here, Deborah. You know, there's a lot of different thoughts out there, right? Sometimes people, when doing retirement planning, they say, oh, I'll only spend 70% of what I spent while I was working, or I'll spend the same, right? And what we're finding is these 70 or 80% amounts aren't actually what actually happens, right? Because like yourself, Deborah, people want to go, they want to travel, they want to experience, they want to do different things. And so it is okay to spend more in retirement than you spend today. And Deborah, you're not alone. It's not irresponsible. I actually see this a lot. Now, this all assumes that you've saved enough money to be able to do so. And so I think it's important, Deborah, and anybody else that's thinking this, right? Like, hey, how much is it okay for me to spend in my retirement years? Here's something that you want to go through. You want to go through putting together an income plan. Now, you've heard me talk about income plans a lot on this show, but it becomes really important when it comes to retirement years. Because what that income plan is it's going to take a look at all of your different sources of income. It's going to look at when you're going to retire, when are you going to start Social Security, maybe you've got some pensions, when are you going to start those? And by putting together that income plan, marrying that up with your expenses, right? So expenses minus income, that's going to equal what your portfolio withdrawals will be. And understanding those withdrawals is what's really important. That's going to help you kind of marry that up or align that with your investment bucket, your retirement savings, to say, okay, hey, can we make all of this happen? So as you're saying, Deborah, right, that, hey, I'm looking to spend X amount in my retirement years, whether that's just natural lifestyle or you plan to travel, or maybe you're gifting money, or maybe you're giving to a charitable organization, whatever that might be, you know what your outflow is going to be. Subtract out your guaranteed income sources like Social Security or a pension, and then that's going to tell you what you got to go and withdraw from your investments. And that's where then you start creating your investment plan. So based on that, looking at maybe your withdrawals over the next 5 years, okay, maybe you want to have those on the safer side of your investment plan. I like to always nickname that the war chest. And then anything 5 years out, maybe it's on the growth side of your investment plan. So why did I pick that 5 years? Well, hey, let's just think about like a market correction, right? If the market were to correct, we want to make sure you've got a lot of traveling that you want to do. If the market corrects, we want to make sure that we've got those withdrawals ready to go for you on that safer side of your portfolio, meaning they didn't get hurt, right? They're there. So while the stocks, the growth side might have been down, your safer side, it's there for you. You can make those withdrawals while that growth side comes back up. And so I pick 5 years because, you look at a lot of different corrections through history. We're seeing anywhere from, like the COVID correction was around 3 months, right? But then we're also seeing, there's corrections out there that have taken up to 7 years. So I just kind of pick 5 years, my personal opinion as an average, but you do what feels most comfortable to you. If you think that, hey, the market will, if the market were to correct, it bounce back really, really fast. I've had people feel more comfortable just going with a 3 years of withdrawals on their safer side. I've had people that are leaning more to the conservative side, so they go more to that 5 or 7 years. It all depends on you and your situation. And I think one more thing, Deborah, is just to be prepared to be able to make adjustments, right? Meaning I'm going to kind of call it guardrails. So if the stock market goes down, it doesn't mean that you're going to run out of money. You just might need to make some adjustments to your overall income plan. So instead of, I'm just going to make up an example here, instead of withdrawing, $3,000 a month from your portfolio, you might, if the market, corrects, maybe you have to make some adjustments and only withdraw 2,700. So that's another way to kind of think about it. So is it irresponsible? Absolutely not. It's quite okay as long as you've saved and you've put a plan around it to help understand that your money will last as long as you're needing it to last based on how much you're going to spend. So Deborah and everybody else out there wondering, hey, how much can I spend in retirement? I really hope that helped answer your question. Okay, let's move on to question number 2. We've got Andy, and Andy says, how much of my portfolio is it okay to have invested in just one stock? I have about $2 million, but almost half of it is invested in one company. Andy, you've got a great question here that really helps us explain the importance of diversification. First, before we talk about how much and some rules of thumb, one thing that I really want you to think about, Andy, is emotion versus logic. Again, I'm going to say that, emotion versus logic. Reason I bring that up is I find sometimes people can become so emotionally tied to their company stock, so emotionally tied to a certain investment, so emotionally tied to a certain person that they're not doing what's logically right for them. So I want you to try to kind of clear some space, or anybody else that's listening to this that says, wow, how much should I have in one stock in my portfolio? Try to clear some space and separate emotion versus logic. The other thing is, it kind of depends where Andy's at in life. Meaning, if he's in the accumulation phase of his life, this could still have a pretty big impact on him. He may have time to recover if that company stock crashes. But if Andy's within 10 years of retirement or 5 years of retirement, if he's within a time period where he no longer will have that company paycheck coming in, he'll no longer be able to save and accumulate more dollars, right? He'll start utilizing everything that he's saved up to be able to withdraw from it to live his life. That's a whole different time period than when you're saving and putting money away. So let's kind of think about it towards the latter. Like, let's say you're within 10 years of retirement, and just what are some thoughts and ideas around this? So first off, there's just a good general rule of thumb out there that you'd want to have 10% or less, right? So you wouldn't want to have 10% or more in one specific stock in your portfolio. Right, so if you look at all of your stocks or all of the stocks or concentrations in your portfolio, you'd want to be 10% or less. Now, you might be out there thinking, wait a second, I own 50% of XYZ fund. Well, you'd have to break that fund down, right? So funds might own a few or might own hundreds of stocks. And so you'd have to break that fund down if it's an ETF or a mutual fund to understand exactly in that fund what portion of each stock does it own. But let's just talk and focus on individual stocks, just individual stocks. Good rule of thumb is not to have 10% or more of your portfolio in one individual stock. And I just want to reframe it to you in maybe a different way. Think about this. Think about you're visiting somebody and they're on the 10th floor of a building, right? And you're going to take the elevator up to that building, and there's 2 elevators side by side. And you can actually see today, you've got that superpower where you can see through the wall. And you look at the elevator on the left, and the elevator on the left has got one string holding it up. And you look at the elevator on the right, and that elevator on the right has hundreds and hundreds of strings holding it up. Which elevator would you get in? Well, most of the times when I answer this question, everybody says, hey, I'd get in the elevator on the right. Why is that? Or how does that relate? Well, having so much money in one company stock is like having one string hold up your elevator, or one string holding up your portfolio. So that's kind of like being in the elevator on the left, whereas being diversified is being that elevator on the right. Because if one string breaks, you've got maybe 99 other strings holding it up. So one of the things that I'd recommend is that you start diversifying a little bit more within your portfolio, taking and selling some of that individual position and diversifying it out into the equity space. Now, a lot of people look at this and go, oh man, but my stock was growing, it was doing so well. And here's the thing. Think about it this way, right? just because you're selling that stock doesn't mean you're necessarily moving to cash. You're just replacing one stock with maybe a mutual fund that has hundreds of stocks or an ETF that has hundreds of stocks. So either scenario, you can still get growth, right? It's just now diversified growth. So if one of those stocks were to crash, now you've got, again, maybe multiple others that are helping to hold your elevator up. So you're still putting yourself in a position to potentially get growth. However, by doing this, diversifying that one stock position, you're also reducing your risk. All right, let's move on to question number 3 from Albert. Albert said, should I start my Social Security at age 62 to help pay off my house before I retire? Well, one thing that I find, Albert, just like you said here, you align with a lot of other people that want to have their home paid off prior to retirement. It's just this peace of mind thing, right? Like that comfort, peace of mind. Your home's all paid off. You don't have that mortgage check that you have to send out each and every month. However, I'm not sure if you want to start your Social Security. Here's why. Once you start your Social Security, Albert, you can never go back. And remember, when you take Social Security at age 62, that's going to be a reduced amount from what you see as your full retirement age. So as you get that Social Security statement, it tells you what your full retirement age is, meaning when you'd get your full Social Security amount. It all depends on the year that you were born. So if you were to take Social Security at any age prior to that age, you're going to be taking a reduction. And remember, once you take it, there are exceptions of going back. You kind of have to pay back everything that you took out, but there's really no going back. Social Security is going to be a really, really key piece of most people's retirement income. And so I want you to really think about that before you take Social Security just to pay off your mortgage. Now, the other thing to think about is if you're still working. If you're still working, you make over a certain amount, then they're going to reduce your Social Security check. So if you're still working and you're making over the earnings limit that they talk about on Social Security, this might not make a whole lot of sense for you. Plus the fact that you can never go back, right? And the other part that you want to look at is, well, how much have you saved? How much do you have in retirement savings? Because depending on how much you have there, what kind of lifestyle that you're going to need in retirement, it may be in your best benefit to let your Social Security grow to full retirement age or even to age 70, right, to reduce the pressure, and when I say pressure, the withdrawals that you're going to have to take from your retirement savings. So the more that you let your Social Security grow, the less pressure on your retirement savings. And one last thing here is, we know this year there was a nice little cost of living adjustment on Social Security. I believe it's around 5.9%. Once you take Social Security, that's the number that your cost of living adjustments will be based on. So 5.9% on what you take at age 62 versus 5.9% on what you would take at age 66 or age 70, it's going to be a lot better in those later years than it would be at age 62. Now, Albert, you might say, hey, I got millions and millions of dollars saved up and I'm not working and I'm never worried about running out of money. And so, heck, in that standpoint, maybe it does make sense then to take your Social Security, pay off the mortgage, and just start reinvesting it, right? But I would think, and I'm just kind of more leaning towards that maybe more conservative side of when to take Social Security, but I don't know if I would use it just simply as a tool to pay off your mortgage, pay off your home. So, Albert, I hope that helps. I hope that gives you thoughts on both sides of the table with it. As you can probably tell from a little bit of my discussion there, which way I lean. But, Social Security is a big decision. Make sure it's more of a part of your total plan versus just a tool to pay off one of your loans. This is why it's so important. This actually kind of really goes back to having that income plan in place that we talked about in that first question. So important to have an income plan in place. This is what we put in place for all of our clients that really, again, helps them look at when do we take each and every one of the different income streams? How much are we going to withdraw from the portfolios? And then what it means is it means that you can finally stop wondering. And by doing that income plan, Albert, you might realize that, oh, okay, instead of doing Social Security, maybe it's in your best benefit to let it grow and use other sources right now to help yourself pay off that mortgage. Hope that helped, or hope that made you think a little bit differently when it comes to Social Security. All right, our last question here. Our last question's from Sam. Sam says, I have a whole life insurance policy with a cash value of about $50,000. My kids are in their 30s now, so I don't think I really need life insurance at this point. Should I just cancel the policy and use the cash to pay off my house? Boy, Sam, I tell you what, I'm going to say the same thing that I said to Andy in his question, in our second question there, emotion versus logic. And you've already kind of put the logic to it in your question, but for anybody else that's out there listening that has maybe an old life insurance policy and they haven't reviewed it in a while, but they're still paying on it, or there's a cash value to it, I really want you to hear this statement again, emotion versus logic. I find people can sometimes become emotionally tied to these life insurance policies because if they were to, get rid of it and something happens the next day, oh my gosh, I just got rid of it and then something happened the next day, right? Versus what's logically right for you in your situation, your financial situation, your retirement situation, what's logically right for you. And I see this a lot. I see a lot of folks that, in their 50s, 60s, 70s, they have these life insurance policies. They got, 30 years before while their kids were really, really young. But just as Sam, you mentioned here, right? Your kids are in your 30s now. I'm going to assume that they're off on their own. They're doing okay. They're not relying on you. And I think that's the thought process that we all need to go through is, first off, what was the purpose of your life insurance? Or for those of you still holding it, what is the purpose of your life insurance? And I'm just going to give the generals here, but the purpose of life insurance, right, is that if you were to pass away, those that count on your income, this life insurance, this death benefit, will then help them replace your income. It'll help them maintain their lifestyle. So I think if you're still holding on to this policy, Sam, you have to say, okay, if something were to happen to you, is there anyone that is dependent on your income to maintain their lifestyle? And you also have to look at what you've saved up. How much do you have in retirement savings? How much do you have in just regular savings? Maybe you have a non-retirement investment account. So if something were to happen to you, could that person maintain off of everything that you've got saved up? And if they could, well then, I guess back to your question, why do you have the life insurance? Now, if they would not be able to, then maybe you need this life insurance. Maybe you need to hold on to this life insurance because that's what would help them get through this really tough time. So hopefully that helped you. That's the process that I like to go through with a lot of clients, is just looking at their total picture, their total situation, and then going back to the actual purpose of life insurance and then determine, okay, is this still necessary? Now, if you do decide then to cash out your life insurance, here's one thing that you want to ask them up front. You want to ask them what the cost basis is, meaning in that $50,000 of cash value, there might be a cost basis. Let's just call it $30,000, meaning that $30,000 is what you've put in, but it's grown to $50,000. The reason why you want to ask this question is because you may owe taxes then on that difference, right? So 50 minus 30, you might owe taxes on that $20,000. So you might also want to look at this and understand when should you time when you take the cash value. If you're in a really high income year this year, but you're going to drop down to a lower income next year, then maybe it makes more sense just to wait 1 year to, again, keep more money in your pocket versus giving it to the IRS. So for those of you that have, life insurance policies that you're like, boy, I think I've got something, haven't looked at in a while, or you've just been kind of sitting on it and wondering what you should do with it, I hope these questions, this thought process really helps you review your current life insurance policy and determine whether or not it is still necessary. Well, I hope you found this episode to be of value and benefit. I hope that maybe you've been able to learn from someone else's question. Maybe you're in a similar situation. And if you like the episode, subscribe on your favorite podcast player. Also, if you'd like to see additional videos, podcasts, blogs to help you build wealth and reduce your long-term tax picture, check us out on lifemoneyshow.com. Again, that's lifemoneyshow.com. There's a lot of content there to help you and your financial future. Thanks for tuning in. I look forward to our next conversation to continue to help you live life today and be financially confident about your tomorrow.
Sierens Financial Group is an independent financial services firm that utilizes a variety of investment and insurance products. Investment advisory services offered only by duly registered individuals through AE Wealth Management, LLC. AE Wealth Management and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.